The majority of Americans comply with their fiscal obligations every year, but with the list of taxes growing each day, millions of citizens are now seeking ways to legally reduce their fiscal burden. From income tax to payroll tax, from property tax to sales tax, Americans give as much as 38% of their hard earned money back to the authorities. According to the IRS, the voluntary compliance rate hovers around 82.7%. And after accounting for enforcement and late payments, the net compliance rate is 84.1%. In this program, we'll reveal 20 completely legal, proven, and cheap tactics you can use to reduce your tax bill. Using this completely lawful strategy, you can take advantage of several tax credits and deductions to pay zero taxes, even on a six-figure income. Stay tuned. Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy to have you here. I hope you are doing wonderful, marvelous. If you are, please grab a cup of coffee or tea or vodka. That's right. Before we get into the nitty-gritty, let me first quickly give a shout out to our fans throughout the world. We have Freya Phillips in Natural Bridge, Alabama, Jay Baxter in Chachi, Alabama, and Emma Ray in Aberdeen, Alabama. Thank you so much for your contribution. Thank you for your feedback. We really appreciate it. The number one proven illegal way to pay little to no taxes is contribute to retirement accounts as much as you can. This is very important, folks. If you want to set yourself up for the future while slashing your tax bill at the same time, you want to contribute to tax advantaged retirement account. I'm talking about IRA, 401k, right? We also have 457 plan, 403b. So you have a wide array of retirement vehicles you can use to slash your income taxes. Now, the maximum amounts deferred vary every month. So what you want to do is you really want to you want to go to the website, to the IRS website, to find out what the maximum contributions are. They hover around, for 2020, the maximum 401k contribution, for example, is $19,500. So if you are age 50 or older, you can make an additional catch-up contribution, quote-unquote catch-up contribution of $6,500, which will bring your total 401k contribution limit to $26,000. The limits for 403b and 457 plans are the same. The idea here is to max out your retirement accounts as much as possible. Number two, make student loan payments. Now, the most important thing here is that you can actually reduce your tax liability if you make student loan payments. That's, of course, if you have student loan payments. About 65% of college seniors graduating from public and private nonprofit colleges in 2018 had student loan debts. And this is a number that comes from the Institute for College Access and Success. Now, the thing is that you can always try to pay for college using your own funds, but it is pretty good. It is pretty advisable to use a loan for that, because you're getting a break, financially speaking, in the short run. But you can also get a break, fiscally speaking, in the long run. Once you graduate and are making more money, you can basically go back and pay the student loan. Now, there are some, I would say, deduction phases, right, that really relate to your AGI. The AGI stands for Adjusted Gross Income. So you can deduct up to $2,500 of student loan interest paid per year as what the IRS calls an above-the-line deduction, meaning you can claim it even if you don't itemize your deductions, right? However, this deduction might be limited or eliminated if you earn too much, right? If your modified AGI is between $70,000 and $85,000, and that's the number is, if you're married filing jointly, those numbers are $140,000 and $170,000. So you cannot claim a deduction if your modified AGI is more than $85,000 or $170,000 or more for joint returns. So this is something for you to really think about as you are trying to reduce your fiscal burden. Number 3, put some cash into flexible spending plans. This is very important now. What is an FSA? A flexible spending account is a tax-deferred savings account established by your employer to help you meet certain medical and dependent care expenses that are not covered under the employee's insurance plan. Right? Now, when it comes to FSA, flexible spending accounts, the clauses and provisions are under Section 125 of the Internal Revenue Code. So now FSAs used to be called medical individual retirement accounts or medical IRAs, but the terminology has changed lately. So right now it is called FSA. Now FSAs allow employees to contribute pre-tax dollars to an account set up by their employer. This is very interesting because your pre-tax dollars are worth more than your after-tax dollars, right? Your net dollars. So employees can later withdraw these funds tax-free to pay for qualified health insurance premiums, out-of-pocket medical costs, daycare provider fees, or private preschool and kindergarten expenses. Now, that's the sweet spot here, right? So you are contributing the money pre-tax, but you are withdrawing the cash tax-free. Think about it, right? So if you are in the 25% tax bracket, you are actually saving $25 for every $100 that you basically invest in the FSA. That's pretty good. Number 4, buy a house. If you want to reduce your, obviously, buying property shouldn't be the only, lowering your tax liabilities shouldn't be the only reason why you're buying property, right? But buying a house indeed helps you lower your overall tax bill. So the thing here is that if you're considering buying a property, that purchase may save you money. Not only because mortgage interest is deductible, property taxes are also deductible. So from 2018 rather to 2025, those tax years, you can deduct interest on up to $750,000 of mortgage debts. And this is $375,000 for married couples filing separately. You can also deduct up to $10,000 of state and local taxes, including property taxes and state income or sales taxes. Now, that limit goes down to $5,000 for married couples filing separately, right? Now, remember that this limit won't matter unless you itemize your schedules, right? And how do you do that on your 1040? You do this on Schedule 8. So, as a reminder here, you can claim the standard deduction or you can itemize your deductions, whichever gives you the greater tax benefit, right? So, and the standard deduction goes up every year. For 2019, the standard deduction is $12,200 for single filers and double that, so $24,400 for married couples. So if you don't have enough itemized deductions to exceed the standard deductions for your filing status, buying a home would not impact your tax bill at all. So this is something that you need to keep in mind. We'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweet Kiwi. We are here talking about 20 proven cheap and legal ways to lower your tax bill at all. And we want to first quickly give a shout out to Paige Thompson. She is in Peppermill Village, that's Maryland. Freddie Graham, Rock Forest, Maryland, and Esme Hamilton in Willows, Maryland. Thank you so much. We really appreciate it. And we give a shout out to our millions of viewers and listeners throughout the world. Let's continue. Number 5, go back to school, right? Have you always wanted to finish your college degree or take courses that could improve your career prospects or just explore an academic interest? If you go back to school, if you take classes, you can actually increase your intellectual ability, but also decrease your tax bill. You can take a deduction up up to 20% of the first $10,000 in qualifying educational expenditures you incur every year. So this credit could be worth up to $2,000 maximum. And the good thing is there is no limit to the number of years you can claim it. All right. So that means that taking classes could help you to reduce your tax bill, as I said earlier. And this is something that will also further your professional skills and your intellectual ability. There are also something called education expense. So you have to understand that many education expenses qualify for tax breaks, right? I'm talking about the American Opportunity Tax Credit, the famed AOTC, and the Lifetime Learning Credit. All right. So the American Opportunity Tax Credit is only available for the first 4 years of undergraduate education, and you must be enrolled at least half time in a degree-seeking program. So now, if you qualify, the AOTC, that credit is worth up to $2,500 per student. So if that credit brings the amount of tax you owe to zero, up to 40% of any remaining credit, which is up to $1,000, is refundable. So you can get a check from the IRS from that. Now, when it comes to the LLC, the Lifetime Learning Credit, things are much broader, right? There is no limit to the number of years you can claim it, and you don't have to be enrolled in a degree program or take a class that improves your job skills. Now, the Lifetime Learning Credit is worth up to $2,000 per tax return. All right. Number 6, you can appeal your property taxes. A lot of folks don't know this, but you can appeal your property taxes. Now, this is a great way to reduce your local tax bill, especially if you have if you have property, because the thing is that sometimes municipalities tend to overestimate your property, right? Why? It is in their interest, right? The higher the value of the house of your property, the higher property tax they are able to collect. So the thing is that when you appeal your property taxes, you challenge the value of your home, the value that was used to determine the amount of taxes you owe. If you can prove via an appraisal or comparable sales that your home was appraised too high, you can cut hundreds, if not thousands of dollars off your local bill. So this is something really worth looking into. Now, this is easier than you think. The process is quite simple. There's nothing complicated here. All you got to do is just file some paperwork and perhaps in some cases attend a hearing. That's all. So you get in contact with your city, the revenue department or the revenue agency of your city, and just file the paperwork. All right. Number 7, give to charity, and remember, save your donation receipts. Right. You can claim a deduction for donating to charities. Now, those charities have to be recognized by the IRS, so always make sure you have a receipt. Charitable contributions are tax deductible if you itemize, so it is important. If you make $100 or $200 and you itemize deductions, and the amount of itemized deduction is lower than your standard deduction, you cannot claim those charitable contributions. So, the idea here is to be generous, right? You want to give based on your ability, based on your budget, but make sure that you have to itemize your deductions to be able to claim to deduct your donations, right? Now, the documentation requirements when it comes to showing receipts for your donations are as follows. So for cash donations under $250, the IRS wants to see bank records. I'm talking about bank statements, credit card statements, canceled checks. For a cash donation of $250 or more, you want to get a statement, right? You want to get a written statement from the organization you gave to. So it has to be, and this is a very standard statement that must include the name of the organization, the amount of cash that you contributed, and a statement that you received no goods or services from the organization in exchange for your contribution. When it comes to property donations, if the property is under $250, you get a receipt from the organization And if this is a non-cash contribution worth $250 or more, you need again a written statement from the organization. And when it comes to property, you also have vehicle donations. The same reporting requirements apply when you donate a vehicle to charity. Now, number 8, invest in an HSA if you're eligible. Now, what is an HSA? This is a health saving account. If you can contribute to a health savings account if you have a high deductible medical plan. Now, the thing is that the contribution unused for medical expenses can roll over indefinitely and grow tax-free. And this is similar to the assets in a retirement account. This is wonderful. Now, HSAs are a great tool to invest in your future. So there is no reason not to put money into them if you are eligible. Now, speaking of health insurance, if you have a high deductible health plan, you can be eligible to invest in a health savings account in 2019 and 2020 and beyond. So go and ask your employer or talk to your benefits administrator to find out. Now, if you have self-only coverage, you should be eligible to invest in an HSA if you have a deductible of at least $1,350. If you have family coverage, rather, you may be eligible if your deductible is at least $2,700. Remember, if you're allowed to contribute, you can invest up to $3,500 for individual policies or $7,000 if you have family coverage, right? So this is pretty good. So just to wrap it up here, folks, when you put money into an HSA, remember, you invest the funds with pre-tax dollars. So you can really reduce your taxable income by $3,500 or $7,000 if you max out your contribution. We'll be right back right after this. Don't go anywhere. Welcome back, folks. We're still talking about 20 proven ways, cheap ways, legal ways to lower your tax bills. And if you like the kind of comments we are putting forward so far, please consider subscribing to our channel, like, share, comment below. Let us know your opinion about your experience rather when it comes to reducing tax bills. We want to share knowledge with the community so everybody knows what's really going on here. Number 9, have a baby. This might sound a little crazy, but this is really, it helps. Kids come with a whole bunch of tax breaks. Now, I'm not even talking about tax breaks, but kids are blessings, right? But when it comes to fiscal obligations, they are more than a blessing. They can help you get some tax breaks. Now, I'm not telling you you should add another child to your family because of tax reasons, but you should be aware of all the federal tax benefits you get for your bundle of joy. Now, you have the child tax credit, right? So that's $2,000 per qualified child under age 17. So $1,400 of that $2,000 is refundable. So you get an actual check from the IRS. Now, if you have a child, you can also be eligible for an earned income tax deduction at a higher amount than if you're single, and that could entitle you also to claim head of household filing status instead of single status, provided, of course, that you meet specific requirements related to supporting your child. So you don't have to be in a regular relationship to claim the head of household filing status. So even if you are a single parent and you can prove that you are meeting specific requirements when it comes to supporting your child, then you can claim that head of household filing status. If you have a child during the tax year, even if you give birth on December 31st, you are considered to be a parent all year long for tax purposes. So again, you have plenty of time to plan your family addition, if you will, and you can claim all the credits that come with that bundle of joy in 2019, 2020, and beyond. Number 10, select the correct filing status. This is, we see this a lot. A lot of folks are missing out hundreds, if not thousands of dollars because they are checking the wrong filing status. So your filing status has a huge impact on your tax situation, right? Because it ultimately determines your standard deduction and your tax rate, right? So, for instance, the standard deduction in 2019 was $12,200 for a single filer, and but that amount was $18,350 for a taxpayer claiming the head of household filing status, right? So, as I said earlier in the previous section, the tax brackets for a head of household are more generous than those for single filers. So, depending on your situation, you may have the option of choosing between two different filing status. Now, there are five available filing statuses, right? Single, that status is for taxpayers who aren't married or who are divorced or legally separated under state law. Married, filing jointly, right? This is self-explanatory. Married, filing separately. So a married couple can choose to file two separate tax returns. However, selecting this filing status rarely results in a lower tax bill. The fourth available filing status is head of household. We already talked about that. And the last one is qualifying widow or widower with dependent child. So this status is available to taxpayers whose spouse died during the tax year or in the two preceding tax years, and they have a dependent child. Number 11, you want to defer income if you'll make less next year. This is more strategic, really, if you'll think about it. So let's say that you think you're going to make a lot this year, right? But a lot less next year in the following year. So you can try to divert or push away as much income as you can until later, right? That way you can actually spread your income over 1 or 2 fiscal years. That will also reduce your tax burden, right? So for instance, if you are expecting a bonus, you can talk to your manager and ask him or her to delay paying the bonus after January 1st. Or if you're self-employed, you can hold off on invoicing some of your clients until the new year comes. So those are little things you can do to reduce your tax burden. Number 12, and this is very important, folks. You want to have a professional prepare your taxes. Now, a qualified tax professional, I'm talking about enrolled agent or a certified public accountant, a CPA. They might charge you more than a non-credentialed preparer, right? But they are required to follow a code of ethics and obtain a certain number of continuing education hours each year. So that means that if you hire this sort of professional, you are actually buying quality. You're buying, I'm not saying a non-CPA or a non-EA enrolled agent is not qualified. I'm just saying that if you go with someone who is licensed or with somebody who is credentialed and who has to follow a certain number of hours in CPE, continued professional education every year, the expectations are higher, right? So those professionals are required to keep some kind of qualifications, some kind of skills. They have to polish their skills all the time. So, and the good thing here is that by spending $100 or $200, depending on your tax situation, on professional tax filing, you are actually saving. You could save potentially hundreds, if not thousands of dollars. So the ROI, the return on investment on this particular approach is humongous. It's wonderful. The good thing here is that some tax pros even offer a guarantee so that if it turns out you paid more than you should have, you get a reimbursement from the tax preparer. And even better than that, you can deduct the tax filing fees on your tax return. Right now, for more info, you can basically go to the IRS website, irs.gov, and the agency maintains a database of credentialed preparers. Right, so that could really help you also. We'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I'm just having a wonderful time here. If you just joined us, please remember that we are talking about ways to save you money when it comes to taxes. We're talking about 20 proven cheap and legal ways to reduce your tax liability. All right, before we just jump into the nitty-gritty, let's give a shout out to Catherine Spencer. She is in Fort Oaks, North Carolina. Alfie Evans in Wanchese, North Carolina. And Lily Lee in Franklinville, North Carolina. Folks, if you just joined us, please consider subscribing to our channel. We want to grow this community. We want to share some nice quality data with you. Like our content, share it. Comment, give us your opinion, give us your feedback, give us your experience when it comes to taxes. This is wonderful. And we also wanted to give a shout out to our millions of viewers in Canada, Australia, New Zealand, in the UK, and South Africa, and the whole world. We really appreciate that. Number 13, use the right software tools. Now, if your tax situation is pretty easy and straightforward, you can file your own taxes using free tax preparation software, right? You can, I'm not naming names here, but if you go online and if you even go to the IRS websites, the agency lists of free tax preparation software providers there, and you can just get your taxes done ASAP. The thing is that there are limits when it comes to how much you earn, and there are limits rather when it comes to using those free tax preparation programs. So if you earn more than $50,000 or $60,000, then the free part is gone. So this is something you want to think about very importantly. Now, for more complex tax return, please again go back to an expert or use a combination of tax preparation software that you're paying for an expert. That way you can actually save money. Number 14, bundle your deductible expenditures, right? Now, if you have lots of tax deductions such as medical expenses, charitable contributions, mortgage interest, now you can those deductions are only available to you if you itemize, right? Because as we said earlier, if your deductions do not exceed $12,200 for singles, for instance, or $24,400 for married filing jointly, then it doesn't make sense to itemize. Okay. Now, there is a way to bundle your deductible expenditures. Now, this means that you are actually making 2 years or 3 years worth of deductible payments or contributions in one taxable year. Let me give you an example. Let's say you want to donate $5,000 annually to a charity, right? Now you can consider doing that by donating $10,000 in 1 year. So you actually deduct the whole $10,000 in 1 year, although this $10,000 will apply for 2 years. In other words, you have an agreement with the organization, with the charity, that you are going to donate to them every 2 years or every 3 years for that matter. So instead of giving $5,000 3 times over 3 years, you donate $15,000 in a single payment, and you do this every 3 years. So that really will bump up your deductions for 1 year, right? So you can deduct up to $15,000 in deduction in the year you make the donation. This is very important, and you can apply the same strategy to other things, right? It could be mortgage, interest, medical expenses. If you have a medical procedure that is you can do, and it's medically safe to do every 2 years or every 3 years, think about bundling those medical expenditures around that frequency. Number 15, you want to make energy efficient improvements to your home. Now, believe it or not, you can actually get a tax break for making your home more energy efficient. There is a wide array of residential renewable energy tax credits available to homeowners in 2020 and 2019, 2020, and that could save you a fortune. Now, residential renewable energy tax credits are available for things like installation of solar power to power your home, as well as the installation of solar powered water heaters. And we all know those are two biggies when it comes to saving electricity, right? Especially if you live in places they have those ups and downs in temperature, such as California, New York, and so on and so forth. You can also claim a credit for wind turbines, renewable energy fuel cells used to generate power for a home, and geothermal heat pumps. Now, the credit varies from state to state, but the credit can go as high as 30 to 35% of the cost of your home improvement project. So there is no really maximum limit on how much a credit you can claim unless you're claiming for fuel cells. So this is something you want to think about. Number 16, move to a lower tax state. Let me repeat that. You want to move to a lower tax state. Now, this is something that is possible if it makes sense, right? If it makes sense from a job perspective or a family perspective, you want to think about it. There is a huge difference in state taxes from one city to another. Now, in fact, there are some states where you can live where you pay no taxes at all on your income, while others impose a high tax burden. For instance, in California, you have the income tax rate is 13%, 13.5%, which is the highest in the nation, followed by Hawaii, 12.5%, New York, 12%, and New Jersey, 11%. Those are the four states, the high income tax rate states in the nation. Now, on the other end of the spectrum, you have states where income taxes are so low, you will feel like, wow, this is just fantastic, right? So I'm talking about Michigan, where the rate is 4%, Indiana, 3.5%, Pennsylvania, 3%, and North Dakota, 2.5%. So this is very important. So if you have flexibility in where you work or live, or you are retired, switching to a state where you pay far less of your income in taxes could help you keep much more money in your pocket, right? So remember, not all of your state and local taxes may be deductible on your federal return, right? So this is something you want to think about. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still here talking about ways to save money, ways to pay less taxes, of course, legally, right? Using the right regulatory tools. Number 17. Before I talk about number 17 here, let me quickly give a shout out to Kayla Dixon in Shelby, Montana, Elliot Bailey in Lolo Hot Springs, Montana. I love this city, Lolo Hot Springs. And Tegan McCarthy in Sumatra, Montana. Number 17, profit from your investment losses. Now, of course, profit is in quotes here because, you can't profit from a loss, but you can profit from a loss by getting a deduction. So if you have losing investments, selling them allows you to harvest your losses to offset taxes on investment gains or to reduce your taxable income by up to $3,000, right? So this tactic can be wonderfully beneficial if your income is going to be higher than normal and you just want to get pushed into a higher tax, you want to avoid being pushed into a higher tax bracket. Or if you just want to sell investments that you'll need to pay short-term capital gains on, right? So we all have, if you have a portfolio and you had an investment portfolio for many years, not all investments will be profitable. Some will be losers. You might have 20% of losers and 80% of winners. And at some point you might want to part ways, quote unquote, with those losers. And it's pretty good to do that if you know that you're going to have a huge amount of capital gains in a year to sort of, have some losses so that you can just, have some tax benefits there. Number 18, keep track of your medical costs. Now, everybody's getting sick from time to time, and if you incur significant medical expenses, you may be able to take a deduction for the funds you spent, right? So in 2019 and 2020, you can deduct unreimbursed allowable medical expenses only if they exceeded, and this is very important, only if they exceeded 10% of your income. That's up from 7.5% in 2017, 2018, right? So, but to claim this deduction, this medical deduction, you need to itemize, right? So this might not make sense for you if you have a large standard deduction and this is, $12,200. This doesn't make sense. But regardless, you should keep the bills you incur throughout the year. If your costs are high enough to hit the threshold for the deductibility, you want to be able to take advantage of the tax savings to offset some of your big care expenses. Number 19, save for college for the kids in your life. This is important. If you have a kid, saving for college is great. It's a great opportunity, right? And you do so in something called, in a vehicle called 529. Even if you don't have your own child, you can open a 529 plan for other kids in your life. I'm talking about friends, nephews, nieces, grandchildren. You can even open a 529 to save for your own college tuition if you're planning to return to college. So the good thing is that the contribution to 529 accounts, they are not tax deductible on the federal level, but the invested funds grow tax-free. So this is something you got to think about. And of course, you can reduce your state tax bill by contributing to a 529 plan, right? Now, if you are able to deduct all the taxes you paid to your state from your federal taxable income, now you are capped at deducting a maximum of $10,000. Now, either way, it's always good to contribute because, again, of what I said earlier, the contribution is not tax deductible, but the invested funds grow tax free. So if you are, say, in the 20% tax bracket, you pay $20 on every $100 that you contribute to the 529 plan, and you are able to have a great investment that returns more than 20%, you are a winner, right? So 20% tax, 20% tax cost, and you have a 40% or 100% return on investment. That's a great deal. Number 20, deduct all business expenses you are entitled to. Now, there are a lot of business owners who forget to deduct their expenses because they have a poor record keeping procedure in place. So this is something you want to really pay attention to. You, as a business owner, you have a lot of different deductions you can claim, right? A lot of folks are reluctant to take advantage of those deductions because they are scared about being audited, right? People are scared about the home office deduction. Now, if you are legally entitled to a deduction, you should never be afraid to claim it, right? Just make sure that you know the IRS rules and you can prove you're in compliance. And the thing is that try to classify as much of your spending as possible as a business expense. So let's say, for instance, you're trying to go to Europe for vacation, right? You can try to time your trip to attend a conference in Europe while you are there, right? So while you're there, let's say Paris or London, for instance, you can deduct the cost, right? Make sure you know the rules. So if you want to spend a few days in London, just, book a conference, a workshop, or a seminar, and during the day, you just attend the seminar, and at night, you just chill and relax and just walk around and get to know the city, right? We'll be right back right after this. Go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're just still here talking about the proven cheap and legal ways to save money on your taxes. I want to quickly give a shout out to Alexis Hunt. She is in Castelia, Iowa, Breckenboyd in West Branch, Iowa, River Irwin in University Park, Iowa. Thank you so much for your support. Thank you for your feedback. We really appreciate it. For those who just joined us, please subscribe now. Smash the subscribe button. We want to grow our community. Like this content if you believe we're adding value to you. Share with people who need to hear this. We want more people to hear this so they can save money on their taxes. Comment below. Give us your opinion, and please, you want to watch our pro tip. This is very important. We have an important pro tip for you, and you don't want to miss that. Now, let's quickly give a recap of what we talked about today here. I gave you 20 proven, cheap, and legal ways to save on taxes, right? And here they are. Contribute to a retirement account as much as you can. Make student loan payments. Put some cash into flexible spending plans. Buy a house. Go back to school. Appeal your property taxes if possible. Give to charity and don't forget to save your donation receipts. Invest in an HSA if you're eligible. Have a baby. Select the correct filing status. Defer income if you know you'll make less next year. Have a professional prepare your taxes. Use the right software tools. Bundle your deductible expenditures. Make energy efficient improvements to your home. Move to a lower tax rate. Number 17, profit from your investment losses. Of course, profit here is in quotes, right? Keep track of your medical costs. Number 19, save for college for the kids in your life. And number 20, deduct all business expenses you're entitled to. Now, what is today's call to action? Now, in every show, we have a call to action. For us, it's very important to leave the viewer with some kind of things to do, and this is very important. Double check your paycheck. So, one of the first steps to follow if you want to reduce your taxes here is to double check your paycheck, because on your paycheck and on your 1099 and on your 1040, there are clues. There are things about your pay that could help you find ways to reduce your taxes. Don't ignore the IRS. If you get a letter or any kind of correspondence from the IRS, make sure you respond. If you don't know what to do, get a lawyer or get an accountant who can help you. Decide who will prepare and file your taxes. If you're a family in the family, decide who in the family will do it. If not, just outsource the whole thing to a tax preparer, right? We talked about an enrolled agent or a CPA. If you cannot afford a tax pro, check out alternatives, right? Software, that kind of stuff. Make sure your beneficiary, the designations are up to date. You want to max out on retirement plan contributions now. I'm telling you things you should do right now. Okay? Whether we are in the tax season or not, doesn't matter. You should do things right now. You want to shield yourself from tax scams and fraud. Again, the best way to do this is to either use software or outsource the tax preparation to someone you can actually see. So a local enrolled agent or tax preparer or CPA. You want to consider bunching deductions, right? We talked about it. You want to bundle deductions. If you do not qualify if your itemized deductions for 1 year are lower than your standard deductions, it's better to bundle deductions. So really make some deductions every 3 years or every 2 years. I give the example of charitable donations. So this is something you can do. Also, you want to think long term. Very important, right? You want to convert, for instance, your IRA to a Roth IRA. So those are little things that can help you to really reduce your taxes and have more ka-ching in your pocket, right? We'll be right back right after this. Don't go anywhere. All right, here is our pro tip. Double check old returns. Old returns, your old tax returns contain a wealth of info when it comes to expenses you have deducted in the past, right? And this is very important, especially if you will need to complete Form 1040X to amend your return and claim a refund. Keep in mind the IRS tends to scrutinize amended returns closely, so be sure your information is accurate and complete before submitting it to the agency. Thank you, and I'll see you next time. And remember, stay marvelous.